Hi, I'm Miranda from Finance Talking, and I'm going to be telling you all about bond basics. So, first of all, what is a bond? Well, a bond is just a tradable chunk of debt. Or you could refer to it as just an IOU. So, a bond can be issued by a company or by governments, and it's a way of borrowing money direct from investors rather than going to the bank. So the picture that you can see here is an example of a bond. And what we're going to do first is just deal with some of the jargon. So the first thing you can see is that we've got the company's name on the bond. And the company we would call the issuer of the bond. So in this case, it's Megacorp. Megacorp is the company that's actually borrowing money by issuing this bond. The second thing we have is the par value. And that is just the face value, it's just the amount borrowed. So Megacorp has borrowed £100 or $100. In actual fact, Megacorp's likely to have issued a lot of these bonds, so the amount that it will really have borrowed is a lot more than £100 or $100. But in terms of each bond, each one represents a little chunk of loan, a little chunk of that bigger loan. Then we've got the date. You can see it says due 2026, and that is, of course, the repayment date. So Megacorp has borrowed £100 for each bond, and it has to pay it back in 2026. Then we have the 5% coupon, and the coupon is the interest rate on the bond. So it's just the interest rate, the interest that Megacorp is paying to compensate investors for the risk they're taking. So, of course, the investors are lending money to Megacorp. They're lending £100 for 10 years. And in exchange for that, they're getting £5 a year interest. So why is it called the coupon? Well, in the olden days, when bonds were issued in paper form, they would have had a series of coupons on the bottom. And when it came to time to pay the interest, what you would do if you were an investor is you would snip off one of these coupons, you would fill in your name and address, and you would just mail it to the company. And the company would send you back their interest check. So that's how you would tell the company that you had their bond, and that's how they would know to pay you the interest. And it's still called the coupon today. The way that the coupon's decided is by looking at similar bonds with a similar risk profile. Of course, if you offer too little interest, then no one's going to be interested in buying your bonds. But you obviously don't want to offer more than you have to. So to help assess how risky the bond is, the company will often pay one or more of the big credit rating agencies, Moody's or Standard & Poor's or Fitch, to rate the bond. So you can see here, here's the credit rating that we have on this bond. So I'm going to put credit rating. And we said that the rating agencies are people like Moody's, Standard & Poor's, S&P, and Fitch. They're some of the biggest. And those rating agencies will rate the bond according to the probability of default. That's the probability that something will go wrong, like the company won't pay its interest or it won't be able to repay the bond in 2026. So these ratings start with a variation on AAA, AA, single A, triple B, double B, single B, and then through the C's until we get for D, which stands for default. So this is a bond that's not paying its interest or hasn't repaid the capital. So you can see that we've got very low risk bonds up here, and we've got very high risk bonds down there. So we're moving from low risk at the top to high risk at the bottom. And therefore, you would expect to pay a lower interest at the top and higher interest at the bottom. to compensate the investor for the higher risk they're taking. There's actually a really big gap between triple B and double B, and that's because everything that's triple B and above is what we call investment grade, and everything that's below that is what we refer to as junk bonds. So obviously with a much higher default risk. So that is the credit ratings. Now, the final thing we're going to look at is what makes bond prices move. So the price of the bond in the market will usually start off at the par value. So normally when the bond's first issued, it'll be issued at par. So in this case, at 100. But things change, and after the bond's first been issued, then the price might go up or the price might go down. So let's think about the sort of things that will make the price go down. So price goes down. One of the first things that will make the price go down is a lower credit rating. So if the company's credit rating is downgraded, we might say. So in this case, if our bond was downgraded from single A, which is a really strong rating, to double B, let's say, which is quite a big downgrade, then investors would be expecting significantly more interest in order to compensate them for the risk they're taking. So the original investor in this bond would be highly unlikely to be able to sell the bond for 100. People just won't be prepared to pay that much, and so the bond price will fall. The second thing that's going to make the price of the bond go down is if interest rates rise. So the reason for that is that when this bond was issued, a sensible interest rate for an A-rated bond was 5%. But if prevailing interest rates have gone up, then it could be that this sort of bond now is paying 6 or even 7%. So when investors look at this bond, they'll say, well, it's only paying 5%, that's not enough, and they won't be prepared to pay £100 or $100 for it. So when interest rates rise, bond prices tend to fall. So by contrast, if we think about the things that makes the price go up, the first thing will be if the rating is upgraded. So rating upgraded. So if this bond's rating went from single A to double A, then investors would be prepared to pay more because they're getting such a good return for the level of risk they're taking. And then the second thing, of course, that would make the price go up would be if interest rates were to fall. So the reason behind that, well, if interest rates fall, then it's likely that new bonds being issued at this credit rating would only be paying 3 or 4%. So this bond paying 5% suddenly looks really attractive, and that would encourage people to buy, and that will push the price up. So that's the bond basics video. If you want to see how bond prices move and understand bond yields in a bit more detail, then watch our next video.